Alright, welcome to video 3 of phase 2, trading plan development. This is something that's crucial. This is something that every trader will have, and this ties into risk management. It ties into your psychology. It all ties in together, because having a strict trading plan is going to be absolutely crucial to becoming a consistently profitable trader. There are some key things when you're in this space long enough and you've been talking to lots of traders and you've been through the motions and the ups and downs and you've come out on the other side as a profitable trader, you'll realize, start to recognize where people are lying when they say they're profitable traders. One example is somebody that doesn't use a stop loss. If somebody does not use a stop loss, I can guarantee you they are not a profitable trader, because I have never, ever, and nobody I know has never met somebody that is a profitable trader that doesn't use a stop loss. I've also never met a profitable trader that doesn't follow risk management. I've also never met, and nobody I know has ever met, a trader that doesn't follow a trading plan. And your trading plan will change from time to time. It's not always going to be the same. It will adjust as you continue to update it and optimize it. But risk management is built right into your trading plan. All right, so what is a trading plan? A lot of people don't know what it is. So a trading plan is a guide or a set of rules that outlines key elements to follow to keep you disciplined and consistent. So when you have a certain set of rules that you follow as a trader, and these rules are what give you the edge in the market to make money, if you break those rules, now you've lost your edge. So if you break the rules that you defined for your trading plan, and that's also inside of your trading plan is what a ideal trading setup looks like, what your confirmations are. If you take trades that don't have all of your confirmations, you've just broken your trading plan. And I have yet to meet a trader that is a profitable trader that breaks their trading plan or takes trades that are a little bit weird, they don't look quite right, or ultimately is just searching for trades when there really isn't any opportunity that they can clearly see. So make sure you also track your trades with a journal. You can buy trading journals online. You can create your own. I just have a little trading journal of my own. It's a little small pocket book where I will write my weekly goal. I will write the pair I traded, the lot size I used, and the percentage won or lost. I will not write the money I made or the money I lost. I will write it in percentages. And if I hit my weekly goal, I will stop trading for the entire week. And I've done it where I've hit my weekly goal on Tuesday and I didn't take a single trade for the rest of the week, and I was happy with my profits and I kept them. I've also had weeks where Monday I didn't trade, Tuesday I didn't trade, Wednesday I didn't trade, Thursday I didn't trade, Friday the setup was there, boom, hit my whole weekly percentage in one day. I've also had weeks where I hit 1% a day. I've also had weeks where I hit 2% one day, 1% another day, another 2% another day, and that was my week. But you need to track your trades with a journal, because just like if you were on a boat and you don't have a map and you just think, okay, I'm going to go in this direction because I think the island I want to go to is over there somewhere, you are very likely, almost guaranteed, to just completely miss it and not end up where you want to be. If you're going to shoot a arrow at a target and you don't even know what the target looks like, but you're supposed to shoot the arrow and hit the target when you don't even know what it looks like, how do you even know where to shoot? Okay, so this is the same thing when it comes to trading. If you don't have somewhere you want to take your account to, if you don't have your weekly goal, where's the ceiling? Where do you suddenly stop and say, I'm happy with my profits? Because if you don't have a weekly goal percentage that you want to hit, and daily percentage is not a great idea. I would say weekly percentage, because some days there's not optimal trade setups in every single day. But if you have a weekly percentage goal that you want to hit, and you work towards that goal, and you have that target, and you hit that target, and you're happy with that target, that is a great target to have. If you have no target and you're just winging it, and you think, I'm just going to trade and trade and trade anything I see, any setup that I see, you're just going to end up over trading. You might make some money, but then you'll lose it all back again. So it's very, very important to, at the beginning of each week, have your goal, have the pairs that you like to trade, and work towards that goal for the week. Now, why you actually need a trading plan is a lot of reasons. Okay, there's almost too many to list. But for starters, it reduces emotions when trading. So if in your trading plan you have a specific setup, you have rules, you have a principle that you follow in your trading plan, that is all a mechanical way of trading, if you will. So when AI bots trade in the Forex market, they will just trade the same setup over and over and over and over and over again. And they don't hit every setup, they lose setups. But they're consistently profitable because they're doing the exact same thing. So when you have a trading plan that says, I'm going to trade this session, I'm going to use this risk, I'll stop when I lose this much, I'll stop when I gain this much, and I'm going to do this, and I'm, all these different rules that you have, this pulls your emotions out of your trading, and it puts you in a completely analytical and mechanical perspective, and that's where you want to be. It builds discipline as well. It's very, very important to be a disciplined trader. It exposes gaps in your edge. So whatever you define in the market as your edge, whether it is, you want to look for bullish, higher time frame structure, you want to look for an imbalance on the bottom side, you want to look for an institutional candle or order block there, and your higher time frame bias lines up, you have a target on the top side, it comes back into the London Open, that is your setup, everything's there, and you pull the trigger on that, and it fails, and then you pull the trigger on something like that again, and it fails, and you pull it on something like that again, and it fails, you might have to reevaluate your edge, because you might be doing something wrong. Now, over a series of 10 trades is where you should really take your data. So what you would want to do is take paper trade or demo trade, the setup that you define over 10 trades, and see how profitable it is. But if in your edge is price is going up, so I'm going to buy it, and I'm just going to put my stop loss below the old low and just do 1% risk every time and just trade breakouts and trends and chase it, and that's what you defined in your edge, and then you start taking lots of losses, that exposes a gap in your edge. But if you put that edge in your trading plan, now you can see, okay, my edge is not good, I'm going to redefine this, I'm going to make it better, and then I'm going to trade every setup now that I've defined as my new edge. And you always want to be constantly keeping on top of that and keeping it optimized and staying in flow with the markets. And it creates consistency as well. It really does. It creates you into a consistently profitable trader. If you're not following a plan, you don't have consistency. You don't have consistency on your risk. You don't have consistency in your goals, where to take profits, where to put your stop loss, when to stop when you're losing, when to stop when you're winning. What is the ideal trading setup? There's so many things that a trading plan will build consistency around that takes the emotions out of trading and puts it in a completely robotic, analytical road. Now you also want to continue to update your trading plan as you go to optimize it. So what can it include? Well, for starters, your trading time or your trading session. So within the New York session, it starts 8 o'clock EST and it ends at 5 p.m. EST. The London session starts at 3 a.m. EST and ends at 12 p.m. So if you were to decide, I want to trade the London-New York overlap where the most volatility is, your trading timer session would either look like 7 to 10 or 8 to 11 or 7 to 11. But in that time frame, those hours that you set out, that is your trading time. So you are going to look for your ideal trading setup between 8 a.m. and 11 a.m. And after 11 a.m., no matter what, you will not take any more trades. You will only trade 8 a.m. to 11 a.m. if that's your trading plan. Doesn't mean you trade London sometimes and then trade New York sometimes, because London and New York move differently, and it's a different type of style that you need to understand in the way the price is delivered during those sessions. If your trading plan is, I'm going to trade London session, and I'm going to look for optimal setups between 2 a.m. and 5 a.m. EST. After 5 a.m., you are done. You are done. That's it. That is your trading time. That is all you're going to do. You're not going to then start looking at 2 p.m. in the afternoon on that same day and start looking for trade setups in Asian session, because that's not the session you trade that you outlined in your trading plan. Okay, so that's one thing you can include. The Forex pairs that you're going to trade. You're going to trade, let's say you want to trade Euro USD, AUD USD, and USD JPY, for example. Those are the ones you're very good at. Those are the ones you're comfortable with. Those are the pairs you're going to trade, and you stick to those. You can put that in your trading plan as well. How much risk you want to risk per trade, so 1%, 2%, 3%. Your mindset rules as well. So it can include things like, okay, how am I feeling this day? My psychology. Is my psychology in check? Am I chasing this trade? Am I feeling scared of the market? Am I feeling nervous? Am I in a completely mechanical mode right now? Because if you're not in a completely mechanical mode and you're not completely detached from the outcomes of your trades, then right there, that's a violation of your trading plan and you should not trade. But how many of us will just skip over that step? Because I can tell you, I skipped over that step many, many times, as has every single trader. And if you're unable to assess your own mindset and your own psychology, or think, I'm going to trade anyways because I'm good at what I do, and you just got a $300 parking ticket, and then the water broke in your house or your condo in the morning, and then you got a call from your spouse that says they want to split up with you, and then you get on the charts, that is not a good time to get on the charts. You should not be trading when you have all that stuff going on, because it's going to come out in your trading. So you need to have your mindset rules, and if you're not feeling good, refreshed, optimized, had a good nutrition, feeling fresh and good to go, you shouldn't be trading. All right, your minimum risk to reward ratio. I said last time, minimum 1 to 3 would be absolute minimum. You can look for minimum 1 to 5. If you don't see a 1 to 5, you're going to wait until something comes up with a 1 to 5. So something to keep in mind as well. Your trade confirmations, like I mentioned, what's the structure? Where is the liquidity? What is price doing? What is the seasonality doing? All these different things that come into your trading are very crucial to identifying the right trade setup. Because what you ideally want to do is have your confirmations. I want to look for structure in my direction. I want to look for imbalance. I want to look for an order block. I want to look for liquidity. And I want to use Fibonacci or something else. So every time you take a trade, you have to make sure that your trade confirmations line up with that. And if they do, then you take that trade. You're going to take every single trade that matches those confirmations. And if a trade doesn't match those confirmations, you don't take it, you leave it, and you let it go. And you wait for the next setup. Your weekly goal. Now, your weekly goal, like I mentioned in the previous video, is very, very important to have a weekly goal. If you don't know where you're going to go nowhere. Your daily loss threshold. This is absolutely vital. So let's say, for example, your loss threshold is 2% a day. And let's say you take a trade on USD JPY for 1% risk, and you take a trade on your USD for 1% risk. So your daily loss threshold is 2%. So if you lose both of those trades, you are done. You are done for the day and you step away. You don't start trying to make it back, over leveraging, scalping, because what happens if you lose that money, all of a sudden your psychology, your mindset comes in and you're starting to trade things that don't have all your confirmations and you dig the hole deeper. So you need to have your cutoff. If you lose your 2% for the day, you're done, and you wait all the way a full 24 hours until the next day to look at the charts and see if there's trade setups that day. And yes, I know sometimes you're sitting there and you're itching to take a trade and it's bothering you and you lose 2 trades, but then all of a sudden it's there. But your psychology is playing tricks on you and you need to understand that and recognize that. So the sooner you can start to recognize that and the more patience you can develop where you have your cutoff. If your cutoff gets hit, you're done and you wait till the next day, that's going to be absolutely crucial to becoming a profitable trader. Now, I wrote and more down here as well. So there's lots of other things you can put in your trading plan. These are just some things that I would recommend putting in your trading plan. There are many others, but these are the key items that you need in your plan. So go ahead, take some time, create your trading plan. Get your trading time you're going to trade. Get the Forex pairs that you like. What's your risk parameter per trade? What is your mindset rules? What's your minimum risk to reward? What are the confirmations you look for in a trade? What's your weekly goal percentage? What's your daily loss threshold? And one more would be, what is the absolute cutoff when it comes to your weekly goals? So let's say, now I've already mentioned this in weekly goal, but let's say you're trading on your account and you hit 5% weekly goal. You can go to either a demo, or you can set out, or you can go to another account that you have and trade that as well if you would like. But you need to keep the same risk parameters for that account. You cannot be gambling and randomly trading and buying and selling on that account, because that's not going to work and you're just lighting your money on fire. So if you have a weekly goal and you hit it on one account, then you can go to another account. Ideally it would be a smaller account and you can use the exact same things. Okay, so just a little side note there. But this has been the end of phase 2. So make sure to review your notes, create your trading plan, and I will see you in phase 3.